Another big drop on Wall Street as the Dow plunges nearly 400 points. A look at what the drop means for your wallet. Plus, our real estate reporter takes a closer look at why credit concerns and the housing market are having such a major effect on the Dow.
Bad day on Wall Street. The Dow Jones Industrial Average, look at it, plummeting 387 points, finishing out at 13,270. Stocks dropping amid worldwide credit market concerns. Take a look at these first few minutes of the day. It dropped about 200 points. Problems at a French bank sparked this sharp drop. The bank said their investors are worried about the troubled U.S. mortgage industry. Other investors, in turn, dumped their equities to find safer places to invest their money. Additionally, AIG, one of the world's largest insurance companies, warned this morning that they are seeing mortgage delinquency spreading.
All right, so why do we keep seeing these sharp drops, and what does it mean to you and your money? KRON 4's Dan Kerman live in the newsroom with a closer look. Dan?
Well, the short answer is the 5-year real estate boom, as we've been hearing, is starting to come to an end, and central banks are waking up and starting to take action.
We're seeing an unraveling effect that is going from Main Street, where the average person could not afford his or her mortgage anymore because of interest rates going up and because the mortgages were faulty to begin with, to Wall Street, where all the banks own the mortgages and now cannot get rid of them.
Analysts say the market is starting to realize this is not an isolated problem, but a global problem, and central banks are starting to take action, as 3 did today. Still, analysts say the best advice for an investor is not to buy or sell, but hold on for the ride.
When markets are moving this fast, as we've seen in the last 6 days, it makes sense for investors just to sit tight. They would get out at the wrong time, they would get in at the wrong time. Remember, half the trades going on in the U.S. these days are done by computers. The little guy cannot compete with that. So markets get too ahead of themselves when there's too much greed. They get behind themselves when there's too much fear. Right now, there's a combination going on. It's a tug of war, and it may be a mistake to do anything right now until it settles down.
Now, analysts say it will settle down when we don't see 200- and 300-point moves on the Dow every day and in the last hour of trading. But one word of warning, there is not a quick fix, and it could go on for another year. Now, as I mentioned, the subprime mortgage meltdown is causing the lending industry to tighten its standards, and that hurts, of course, the housing market. KRON 4's Maureen Kelly spoke to an economist about 3 areas which will see prices fall as a result.
The people who are going to feel this worst are home builders. And in areas where there's a lot of new homes, we're going to see prices affected the most, especially if these are homes for first-time buyers.
That's because of 2 reasons. First-time buyers often need more creative financing to get into their first home. That financing is getting harder to come by as institutions who deal in subprime lending pull back or shut down altogether. The other reason?
When you have home builders who can't just sit on empty homes or don't have any benefit when they do, they need to sell. They've had dried up demand, and that's when you see the prices really come down.
Which is good news for buyers with good credit looking to get in. Another place to watch for bargains, the condo market.
We've had a lot of investors buying condominiums, and that demand's going to dry up because some of that was subprime. And as investor demand dries up, that'll lower the pressure on prices that we've had over the last 5 or 6 years.
The other place where sellers will feel the hurt in this latest mortgage crunch, areas where the prices are already low.
The lower your home's value, the worse you're going to fare in this little coming downturn. The reason is, the problem we're having is at the lower end of incomes and credit, people are having a hard time finding financing.
On the flip side, the areas with more expensive price tags and fewer new homes should do a better job holding their value.
Typically, the buyer of higher-end homes has better credit and more access to mortgages where the credit is not as tight.
In Berkeley, Maureen Kelly, KRON 4.